Hello and welcome to today's IALD webinar, Business Transition Planning, Who, What, When, and Why. My name is Joe DeGuzman, Senior Certification Coordinator for the IALD. This live webinar qualifies for one learning unit from AIA. It may also qualify for continuing education credit for the CLD and LC, both of which are self-evaluated and self-reported. You must attend the entire webinar in order to qualify. More information will be provided at the end of the presentation on this. With that, let me introduce you to our panelists. First, Barbara Horton, IALD Fellow, CLD. She's a co-CEO of HLB Lighting Design. Carrie Hawley, Professional IALD, co-CEO, HLB Lighting Design. Trish Farnsworth, Partner at Lawson & Whiteson LLP. Take it away, Barbara.
Thank you, Joe, for the introductions. Our presentation team thought it would be really good for us to give you some context for our roles and our relationship through our ownership transition journey. I consider myself an accidental tourist in this business. I was an interior designer who stopped along the way to learn about lighting, and I never left. Our firm's 50 years in business have gone by surprisingly quickly, and over the years, we really observed many firm owners aging out with no plan, little financial reward to show for their many years of hard work. But our founder, Jules Horton, thought differently, and by the late 70s, Stephen Lees joined as partner. I joined the firm in early 80s and acquired a stake in the business in the early 90s. So by the mid-90s, we had reached an inflection point. Jules neared retirement. We sought professional advice from a management consultant and our legal counsel, who then helped us establish really a good overall framework and develop a plan for our future. Stephen and I created what we call an internal ownership transition plan. We were in our 40s, and this has really been the springboard for our firm's continued growth. So you're probably asking, why did we do this? We wanted to continue Jules' legacy. That was important to us. We also wanted to give opportunity to others in the business, pay it forward, and of course to have an exit strategy with some financial rewards, not just for us, but for everyone. So looking back over the 25 years since we started the plan, I see great success we've had in our planning, not just for the legacy owners, but also for the growth of the firm and its ongoing leadership team. So I want to invite Carrie to share her experience as one of those young leaders in our firm who took the leap.
Thanks, Barbara. Hello, everybody. I am here representing the buyer generation, as Barbara said, in succession planning. And originally I was trained as an architect, and I entered the lighting industry in the early 90s after I graduated from the Lighting Research Center. And what immediately stood out to me when I very first time met Barbara was her true sense of care and interest that she had for all of the employees. She and Stephen and Jules really believed in mentoring the staff, not only in lighting design theory and in technical things, but also giving us a sense of financial literacy, project management skills, and business development skills. And it was always a collaboration from the start. Jules used to say, I don't care whose idea it is. If the UPS guy passes through the door and shouts out the best idea, then we're going with his idea. And Stephen would always bolster the junior staff, saying that you are more expert in lighting design, even now in your career, than pretty much any of the architects and contractors you're working with. You're adding value. And he'd also say that our company's assets walk in through the front door and then leave out that same door every night. And we just hope they want to come back the next day. So I would say that they really got it. For them, it was about developing people. It was about developing a legacy that they'd created, and it was about developing the future. And I found that to be a really exciting and supportive place to work. And with the exception of a couple of years detour that I took in the late 90s to see how things were done at another firm, I've been fortunate to have created and developed my career alongside what I consider some of the best mentors in the lighting industry. I'm really proud to be one of 8 boomerangs who chose to return to HLB. And why did I return? For me, it was really simple. I saw my future here. Early communication about my value and my potential, in addition to some ongoing trust, opportunity, and development, allowed me to dream very big and allowed me to visualize my future. I became an owner in 2007, and I continue to be mentored in more strategic areas alongside our current shareholder team, which is 14. And early this year, I was really delighted to step into the role of co-CEO beside Barbara. I'm really honored to have taken this journey with Barbara and Stephen, and I hope that our experience today can inspire you all. And now I'd like to turn this over to Trish.
Hello all, I'm Trish Farnsworth and I'm an attorney. I've been with Lawson & Whiteson in Boston for 27 years. We have a corporate team at Lawson & Whiteson that specializes in mergers and acquisitions and ownership transition programs, notably in the space for design professionals. We have handled hundreds of transactions for architects, engineers, land surveyors, landscape architects, and of course, lighting designers, which brings me here and the privilege to join Barbara and Carrie for this webinar. I had the fortune of meeting Barbara Horton and Stephen Lees in the late 90s. In 2000, we worked with them as they identified a few individuals to bring on as owners, one being Teal Brogdon, who remains a current owner. It's hard to believe 20 years has gone by since then. In 2007, additional owners were brought on, and that is when I met Carrie. Thereafter, I continued to assist with their ownership transition program, with new owners coming on, some existing owners taking on more, Stephen retiring, and Barbara with her retirement plan well in process. In addition to working on their internal ownership transition, in 2018, 2 years ago, I worked with Barbara and Carrie and their team on their acquisition of the firm Illumination Arts. I will turn this back to Barbara, and she will explain the objectives of the presentation.
Thanks, Trish. So we are going to talk a little bit about transition planning for your future, common succession methodologies. Trish is going to take us through that. And we put together some critical considerations, things that we experience, we think that you all will appreciate. So we proposed the seminar because we really expect a paradigm shift in the landscape of the lighting design community over the next few years. Some owners are going to retire, some will merge with another firm or sunset their firms. Some may ride out this current storm and recover and thrive as in past economic downturns. And one of the reasons we did a succession plan was to really ensure, as I said earlier, the legacy of the firm, have a solid exit strategy, and hopefully some financial rewards. There are many ways that this can happen, of course, and we asked Trish, who's an expert and has been our advisor, to really discuss some of the opportunities outside of the personal things that we did and that we experienced. So, okay, I'm going to say this session is really focusing on mid-career practitioners, those of you who are thinking about becoming owners in an existing business, those of you who already own your own business and look to the future retirement, and for those who are starting a new practice and thinking about what their future will look like. So we're going to go through the who, the what, the when, the why, and the how. Let's start with the who. So transition planning gives rising talent opportunity for personal growth and solid future, similar to what Carrie just said. Creating future partners or shareholders, in our case, really creates ongoing stability for the company. I've sat on both sides. I've sat as the buyer, learning about shareholder agreements and corporate bylaws and setting up financial methodologies for selling shares. And then a few short years later, I was selling on the other side, beginning a journey to sell shares to our highly valued team members. One of the things I learned along the way was really to use AEC industry consultants to help you understand the complexities of ownership and also what's best for you. Some of the factors that can make or break a plan that we found was, one, the persona of the sellers. That varies depending on their age, their financial circumstances, their family dynamics, leadership style, and their goals. And in our case, we were 40 years old and we decided to make a plan. And as the sellers we created the goals, the valuation formula, we went through the legal process, and then we set up the strategies for selling shares over an extended period of time, 25 years now. Even with a well-planned process, there's a lot of emotion in this journey, as well as a legal one, and Carrie's going to talk a little bit about that. We continually identify potential buyers, their interest in, and develop the culture of transition. We educate, we mentor all of those potential internal buyers because we want them to be better owners. So, what? Both sellers and buyers need to establish individual, personal, and career goals. Aligning the goals leads to healthy terms for the engagement from the start. From the seller's point of view, planning for a business transition doesn't mean giving up control of your company. I know a lot of people think that. It's just the opposite. It allows you to share the risks as well as the rewards of running a company. And transition planning shouldn't be interference if it's well planned. It's a way of protecting and strengthening the legacy that you built. You owe it to yourself, you owe it to your family, to your staff, and to your clients to have a solid plan. Ultimately, the satisfaction of the accomplishment and the financial stability for all your years of hard work are the outcome we all want as we retire. I say that with a smile. Trish will talk about a couple of other ways that this can be done later on. So from the buyer's perspective, well, I think number one, it's the opportunity for personal career growth and to have a meaningful stake in the success of the firm. And you have the ability to control your destiny and impact the firm's culture and reputation. You also start to build your own development areas and, of course, financial rewards. Ownership does come with risks, and if you have a good plan and good communication, you can really overcome all of those challenges, and we've got 25 years to share that. I would advise, and I'm sure Trish will back me up on this, that you revisit the plan, both the seller and the buyer perspective situations as needed to really accommodate essential changes, and also just to really remain relevant. I think that's really important in a firm. So when? What we've learned over the 25 years of succession planning, it's never too early to start planning. I would say the time is now if you're in mid-career, start thinking about that. Don't wait till it's too late. Stephen and I attended our first ownership transition seminar filled with a room of 60-year-olds. And as I said earlier, we were in our mid-40s listening to this conversation. And at the end of it, we were told we were the only smart ones in the room. So be that as it may, there are also lots of things that happen in life, hiccups, life-changing events that really need to have the proper framework to help navigate those changes. Trish is going to talk a little bit about some of the ownership transition options that might happen if, let's say, you're 5 years away from retirement. So not everybody has to start 25 years earlier. That's just the way we are. We also would definitely recommend about every 5 years to revisit your plans, make sure it's working. You know, we're dealing with many different generations now. Generation Z has a very different, need from Generation X. So I think that's really an important factor. And if you're really interested, this is just a teaser seminar, to be honest with you. We can't cover everything, but I would suggest that you look at ownership transition workshops that are offered by many firms. We're going to give some resources at the end. It's really invaluable to begin and understand the process and all the options that are available to you. Trish's team is one of those companies that offers the seminars, and I'm sure she'll talk a little bit about that during her methodologies. So why? Well, I think in retrospect, the greatest reward for me and for Stephen is that the culture and the reputation we built with an amazingly talented leadership team, there's no substitute for that. We could not have done what we've done alone. Ownership transition plan really gave our talented senior team opportunity to develop into great designers with a foundation for business acumen to expand and continue their business. And today we're 90 plus people. We're based in 7 cities throughout the US. We are led by 14 principal shareholders, and we just celebrated the retirement of the second legacy owner. So providing planning and a process that really worked for us. This may not be for everyone, but I would say if you're on that track, Trish is going to tell you how.
Great. Thank you, Barbara. There are several different methods that an owner or owners of a design firm can use to reach their goals of succession. Though there are a number of methods, it really comes down to 2 categories, an internal or an external exit. Internal transitions occur among members of a firm, such as generational transition, which is what Barbara has described, and Carrie will talk about more that happened with their firm. An external transition would be a merger or an acquisition, which is a purchase, or sale to an external buyer. Again, Barbara and Carrie have also been involved in an external transition with the acquisition of Illumination Arts, and they can speak to their experience on that as well. Internal or external does not need to be an either or. A design firm could go with an internal ownership that could very well be successful for a period of time or forever. But if not, or if there are other factors and goals that change down the road, an external event may then be the method at that time. I will provide a brief overview of the how, the different ways owners can transition ownership of a design firm. So an internal transfer could consist of passing the business to heirs, which is not as common today, I do have to say, especially now in the professional, with licensing and such, or selling to current co-owners, but that does not plan for future generations. For design firms, ownership is generally transferred over time to key employees who can eventually take over and successfully run the firm. This is a common method in the design industry, driven by the desire to continue the firm and to get ownership into the hands of the next generation, who are perhaps those best able to influence the firm's continued and future success. Ownership can motivate employees, and it's commonly used to retain those employees who are valuable. The internal transition plan consists of sales of shares directly from the current owners to new shareholders, or more commonly, redemption by the company, which means selling shares back to the company, and then the company sells the shares to the new owners. Payment for the shares are over time by promissory notes, and they're secured by the shares. The goal being that the firm is profitable so it can pay the sellers for the redeemed shares and can provide bonuses to the new shareholders, and those bonuses fund and are used to pay for their shares. An ESOP is another way. That stands for Employee Stock Ownership Plan. It's another method that would be considered an internal transition, though it does not transfer leadership. An ESOP is a legal entity that Congress created to get ownership to employees. The entity is a trust. They call it an ESOT, but we can call it trust here. And there will be a trustee of the trust. Employees of the firm then become beneficiaries of the trust, and since all eligible employees may participate in the ESOP, the beneficial interests in the ESOP are allocated among all employees in a non-discriminatory manner, so they're all equal. They all have the same ownership. There is also a plan that sets forth the workings of the trust. An owner of a firm would typically sell a portion of his or her shares, and that's usually a minimum of 30%, since that's the level for tax-free treatment for the seller. So they sell the shares to the trust for fair value, and that fair value is determined by an opinion from a third-party evaluator. The trust borrows the purchase price for the seller's shares, and there are tax incentives for banks to lend at favorable rates. Then the firm every year pays a proportionate share of its profits to the trust. The trust takes those profits to pay down the loan. Once the loan is paid, the profits are used by the trust to build value. Not all design firms are 100% ESOP. To the contrary, it is common that if a firm sponsors an ESOP, it limits the ESOP's ownership to a certain percentage of the outstanding stock, with the rest of the ownership held directly by the founders or management team. For example, the ESOP could own 40% of the firm and 60% held by the other management individuals. Why use an ESOP? Other than a seller receiving tax advantages on the sale of his or her stock to the trust, and that the employees have an ownership in the firm, there are other tax advantages, such as cash contributions to the ESOP are tax deductible, since the ESOP is a defined benefit plan, and the ESOP can use cash to purchase more stock from individual sellers. One of the external exits for owners is a merger, where usually two firms will determine that they can be better as one. So the owners of each of the individual firms contribute their ownership in the combined entity. The term merger legally means two firms are combined through an exchange of stock and possibly some cash and promissory notes, such that only one entity survives. Sometimes, even though they are not technically mergers in tax or corporate law sense, transactions are called mergers for public relations reasons, so that employees and clients believe it is a teaming or a combination, as opposed to one firm being acquired by another. Even after a merger, the owners at some later date could have their ownership redeemed or sell to the next generation, where that entire combined entity could be sold to a buyer firm. Another external exit is an acquisition, where one firm sells to another firm. That can be a stock or asset sale, which is, a whole nother separate topic. But acquisitions and often mergers can be strategic. Common drivers for strategic transactions are that the combined businesses will be in a better position to compete more effectively or expand into additional services or geographic areas, provide better career opportunities for staff, whether that be financial or professional, such as the opportunity to work on different or larger or more interesting projects. There are also financial acquisitions. In recent years, we have seen numerous firms selling to private equity investors. These private equity firms either purchase all or at least a controlling interest of a design firm. A minority of the ownership may be held or retained by the management team, especially where the private equity firm is acquiring the design firm as a platform company, which is another reason to have a strong management team in place. The private equity buyer then provides capital to the design firm to grow or to allow the design firm to make acquisitions. But the private equity folks are not long-term investors. They typically hold an investment for 5 to 10 years. And at this point, we've represented design firms who have sold a portion to private equity, with the management team holding a minority interest. And already the private equity firm has sold the design firm to a larger private equity firm. And then that management team has benefited from that second sale now financially. So the larger private equity firm will sell that design firm someday, or the grown design firm, because they continue to grow, in a few years, or perhaps go public. Lastly, there is liquidation. But this is generally not viewed as a viable, planned course of action for ownership transition. One may think, I will shut the doors and collect my AR, but it's not that easy. Once you decide you don't want to continue, you turn away new work, but the existing projects need to be completed. Bills and staff still need to be paid. Also, unfortunately, once it is known that a business is closing, the bills that are owed to that business go unpaid, or at least they're more difficult to collect. In addition to not realizing financially what you thought you should get after all your hard work, the other downsides to liquidation is that there is no continued employment for your staff. Your clients have to find a new firm for services, and the legacy firm that you may have built over the years is lost. As Barbara said earlier, it is best to begin your ownership planning early. Many owners delay because they don't want to commit to a certain path. But truth be told, many parts of the planning process apply to many of these transition options. So there are a number of considerations you may want to think about for your own transition planning. Let's look at this next slide. The motivating factors. So for an internal sale, as we mentioned before, you have legacy. Certainly Horton Lee's 50 years. Paternal, maternal feelings. You founded a company, it's your baby. The employees are really your kids, so you have loyalty to key long-term employees. You also want to retain valued employees. You want to maintain the culture. You want to maintain control over a period of time. And there may just not be any outside buyer that is available. On the external side, you maximize the sales price typically. You're in a better position business with the firm to compete or service clients, or perhaps opportunities for your staff. There may be a concern that the next generation is not capable of running the business because they need to run that business and continue it to be profitable for that internal sale to work. They need to make those required payments to their selling shareholders. And then you have risk intolerance on the part of key employees. I mean, there are a lot of rewards for ownership, but there's certainly a lot of risks. And we see that now. We have COVID and a recession. So Barbara can probably talk more and Carrie about that. So of course, there are risks and benefits with both types of approaches, and each method of transition has its own pros and cons. So we can just go through these benefits and risks because you really should explore these when you're thinking of the various methods. So timing. The timing to get an internal ownership program in place is generally 6 months. That would consist of developing a plan, which can take a good amount of time and resources, especially with the first generation firm. Usually internal ownership programs are done over a number of years, 5 to 10 years. But once the program is in place, it's easier for each subsequent generation. The timing for an external sale is much faster. Generally takes 3 to 6 months, and that process is due diligence, negotiation of a purchase or merger agreement, employment agreements. Timing for your transition goals is a critical factor. As Barbara said earlier, you do not want to wait too late or your options may be limited. For example, if we had a firm with 2 owners, one is 65, the other is 67 years old. They don't have that second tier or the next generation. Perhaps they had talented folks that could have been, but those talented employees were never offered ownership, so they left for other opportunities. In that case, an internal sale is unlikely. Furthermore, an external sale may be hard to find, as the buyers of firms commonly do want to see that next management level. So firms that have not considered or planned for succession, then a sale could result from having to sell. And those terms then may not be the best or even ideal for you. Effect on staff. Staff generally resist or they're anxious about change, so an internal transition may be deemed more favorable. But certain buyers can offer more opportunities for growth or economically, so that may be beneficial to the employees. Effect on clients. Similar to staff, how will clients react? With an internal sale, perhaps the clients would be more comfortable, or perhaps clients or potential clients require more services than you can currently offer, so that may be a benefit of an external sale. Firm continuity. We've spoken of this before, but again, legacy, what you've built is critically important to some, and that will continue hopefully with an internal, but is less likely with an external sale. The financial return, generally the amount of the financial return for an internal ownership transition is a little bit less than an external sale and takes longer. The financial security, the external buyer will pay at closing, though usually not 100% cash. Some portion will be deferred, usually 3 years with a promissory note. An internal sale, as we said before, is funded by firm profits, so that goes over a number of years. Control. Giving up control can be emotional for owners. With internal transitions, though, that is usually done over a period of time. An external event, control is lost immediately. Culture. One may say this is the most important factor, and we've seen many successful deals, but if the cultures of the 2 firms are misaligned, we have seen failures in integration, and the result then being an unsuccessful transaction. I'll now hand this over to Carrie.
Thanks, Trish. I'm now going to walk us through many important things to consider on both the buyer and the seller sides. Before proceeding with any succession planning strategy, it's important to take some time to establish a framework that serves as a guide and a communication tool to potential new owners. Just think of it as a roadmap for all involved. And it's important to understand that once a succession plan is in place, there's often a long road ahead to ensure that it succeeds. A good framework starts with establishing a vision. Firm transitions require a lot of forethought and planning, so try to start early and take the time to plan it right. First, try to determine your succession timeline as early as possible. And as Barbara said and Trish said, it's never too early to start making a plan. How do you envision your succession? What's your ideal timeline? Keep in mind that you likely need a minimum of 5 years and ideally 10 to 20 years to successfully pull off a succession plan. It's a process, so give adequate time to that process. Next, identify successors or buyers. Take a hard look at your current staff. Are there any key teammates who you see as potential successors? Make a list and identify their current strengths as well as areas of learning. Do you see them capable of being developed over the years to eventually take over and successfully run the business? Have you communicated your belief in them? And do they see themselves that way? Do they even want to own a business one day? And do they know the risks and the rewards? If the answer to any of those questions is no, then think about if it's realistic to develop future owners from your current staff, or instead, do you need to consider recruiting for outside talent with the goal of succession planning in the mind? Or if you see potential in your staff, then you need to start those conversations early. Once you have your successor candidates identified, you'll need to prepare a business valuation. You need about a 3 to 5 year history of your financial statements, which would include your income statement and balance sheet, as well as your tax returns. You can use established industry metrics to create a formula, which would include 4 to 5 factors with about 3 years average. And then next, you need to create a methodology and terms for funding the purchase. Will that be cash up front or life insurance, bonuses, cash down with promissory notes or bank loans? Finally, it's wise to establish a due diligence process, which may vary depending on the form of the sale. Follow through on the details so there are as few surprises as possible. And keep in mind, life throws lots of unexpected situations our way, so being prepared is always best. Once you've established the who, the what, the when, and the why, it's important to work with a good team of advisors. And there are several groups in the AEC industry to research and consider, and some examples are the Zweig Group and PSMJ. There's even a lighting focused option, which also combines the capability of recruiting depending on your direction and needs. If that's you, then you may want to check out the Pompeo Group's strategic alliance with a group called Tonge Associates. Your process is going to require 3 important things: communication, mentoring, and managing emotions. With communication, regardless of the format of your succession plan strategy, you'll need to think about both internal and external communication. It's a good idea to create a presentation to your prospective internal candidates that you're considering to help with communication and details. This could include a firm overview, your value proposition, your proposal to potential buyers, and the risks and rewards they can expect out of it. It's best to start communicating to potential future leaders early in their careers, so they first of all are aware that you even envision them as potential owners, as well as helping them understand the roadmap to ownership. If you're doing a mergers and acquisitions deal, you'll need to first plan a message to your staff explaining the benefits of the merger or acquisition and the plan for integration. Expect some initial suspicion and questions, which you need to work through to build trust and comfort. Then you need to craft an outside message to your clients to present this opportunity and assure them that the transition is going to be seamless. Now moving on to mentoring. This is truly the most important part of the plan. Identifying, training, and building trust in your successor team is critical. Engage your next generation in a strong mentoring plan that builds over years, helping them in critical learning areas to grow into the leaders they need to be. It's also important in that mentoring to convey the importance of the responsibilities and risks that they'll be undertaking in becoming business owners, while also highlighting all the great opportunities and rewards that can come their way. Mentoring may need to include working with them to define your firm's culture, a complete financial literacy training, an understanding of performance metrics and goals setting, building rainmaking skills, expanding client relationships beyond your current base, and considering expansion into specialty areas, and really important, learning to manage people beyond just design and project management. On top of all that, they'll need to have a basic understanding of legal and HR matters in order to effectively work with outside advisors when needed. And now more than ever, The current COVID crisis is a really good time to mentor your future owners in the cyclical nature of business downturns. Rather than fearing them, they should not only anticipate them, but plan them into the firm's long-term trajectory. And by helping them develop solid business practices, design future-proofing techniques, and even create rainy day funds, will help them learn how to weather any future storms that are inevitable in our industry. And finally, emotions. As we alluded to earlier, this process is often very emotional for both sellers and buyers. Barbara and I speak from experience. Be prepared for some emotional high and low moments. While working through everything, you'll likely encounter some awkward gaps in discussions. Don't try to work it all out at once. You're likely going to need some time in between discussions for reflection and for even outsider advisors' guidance. You may even get differing perspectives from outside advisors that are important to unwind. Legal jargon can be challenging at times, and sometimes financial expectations feel unfair in both directions. It's okay to take time working through all this. Remember that the decisions you make are for both parties. There's no them. The new mindset needs to be we. We often find ourselves preparing for these critical conversations by saying that we all need to come into the discussion with our HLB hats on, which means we need to consider what's best for the company as well as all owners involved. It's important to be reasonable, flexible, and empathetic to each viewpoint. While the process is a bit more complicated than getting married, in our experience, the emotional commitment that buyers and sellers are making feels similar. Emotional intelligence and candid discussions are critical to success. The process can be exhausting at times, but it's also deeply fulfilling, especially when all the final terms are resolved and everyone's compromises have been incorporated. And finally, be prepared that the deal might not ultimately work out. It's okay to walk away, learn from the experience, move on, and consider a new strategy.
So consultants, you really do want to have a team. So you put this team together to understand your options and to assist in ownership transition planning. The team should consist of a management consultant, an M&A attorney, and an accountant CPA. Each of these folks should have experience in working with design firms, and an added benefit, I think, is if one or more of these individuals have previously worked together. There are several firms that provide management consultant or advisory services to design professionals. They, with the accountant, would work on a valuation for your firm. And there are many different ways to value: net revenue, net profit, book value, a formula. So you really need quality advice on valuation. They would also work with you on identifying internal candidates for ownership. Or if there are none, they would look for possible firms that you could sell to or partner with. The M&A attorney's role would be for the internal transition, assisting with the plan and drafting the documents. You would have an internal share purchase redemption agreement, promissory note, share pledge agreement, shareholders agreement, bylaws, deferred compensation agreement, and perhaps employment agreement. For external exits, the M&A attorney would be involved in negotiations of the deal terms and drafting purchase and sale or merger agreements and employment agreements. The accountant CPA would assist with the valuation analysis, provide assistance with analyzing and forecasting financial performance with models, and the very important, provide tax advice.
And then finally, I think, Barbara, we want to speak to the experience of feeling like you need a personal therapist, and sometimes we just serve as therapists through the process ourselves to each other, right?
I think Trish or Carrie, you made the point about, it's kind of like marriage. It's a little bit more complicated, a lot more legal documents, but in the end, if it's the right fit and you've done your due diligence and you really have, common goals and interests and, align all of that from the very beginning, you have success. So, but therapist does help.
Mm-hmm.
Okay, and then we just put on a slide just some resources. I mean, there's numerous ones, but again, I think the key is make sure that you get someone in the design industry. I really think that's the key.
Yeah, I would
Absolutely.
agree with that. They speak the same language. Everyone knows each other, so it just makes it easier. They've seen every form of, business that is out there, and they can really, I think, ask the right questions, which is more important because they understand what designers do and the emotions that come with, the work and the passion that we feel. So I think it's good to find the right people. I think we're done.
We're ready to open it up for questions.
We did. We wanted to leave some time for that. We figured we couldn't cover everything, and we assumed that you all have some good, serious questions for us. I hope for Trish, mostly.
All right. Why don't we do that? We'll start with Trish. Trish, what advice do you have for buyers on how to finance buying into a firm? Starting early usually means you don't have the capital savings to buy shares.
Right. So, and everyone understands that. So usually what you do is you come up with the plan, and that's why you need this whole team to figure out what works for the, I'll call them the founders, the current owners, what's their timeline for exiting, and then to bring in new folks. Sometimes, you do want them to come up with a certain amount of money. It's not something that you have to mortgage your home for, but you do want to have some skin in the game. So there is some money that you come up with. And then basically, the deal is that you become an owner, and usually at the beginning, when you first come on, it's, anywhere from 1%, 5%, usually less than 10%, but it also depends on the size of the firm. So, and again, also the firm valuation for the internal sale is a little bit less because you're not selling a controlling interest of the firm. Where if you were selling to, a buyer or another firm, they're taking the whole thing over. So they're paying a premium. So that's why those sale prices are different than internal. So, in effect, you want to have a fair price to buy in. You have a bit of money that you do need to pay cash at closing, but the rest is really financed, and it's financed by the company. So you perform and the company is profitable, and so every year there's bonuses paid to folks, and then that is used to buy your shares.
I think just to add to that, when you're in that situation, talk about what the terms are. So maybe it's 10% down, maybe it's 25% down, again, part of that negotiation. And then those notes can be paid out over, 5 years, 10 years. We've even adjusted ours. We've changed ours since 25 years ago because things have changed. Also, the valuation of the company has gone up. So now the cost to buy in is a lot harder for some of the younger generation. So we've had to make some additional changes to our terms.
I want to just add something to that, which is that fundamentally what helps is a spirit of ownership transition from the sellers, because the sellers have to be motivated to make the transition happen and to allow the buyers to be successful. So there's a certain amount of massaging of it, if I can put it that way, to make sure that they're likely not going to have big wads of cash sitting around unless if they have personal unique opportunities available to them. So allowing them to have that mentoring side by side and starting to create metrics and points of tracking and helping them establish goals and realize the goals and hit those benchmarks and awarding them through part of the profits that helps that transition happen more effectively.
All right, great. The next questions are for Barbara and Carrie. Barbara, how about you go first and then pass it to Carrie when you're completed.
Okay.
How big is the leadership/shareholder team, and how big is the company? Can you talk more about the process of selecting leadership and the structure and balance of the overall firm?
Okay. So I'll start with the first piece. So we have 90 people. We have 14 shareholders with varying degrees of ownership, but everybody is under 10% at this point. So with those, you can see those numbers are not that high, and there's a reason for that. We definitely want to allow future the next generation of retirees to not have a burden on the company. So we kind of flattened that out a little bit. What was the second question? It was how large is the company? You don't mean just numbers, but What?
Can you talk more about the process of selecting leadership and the structure and balance of the overall firm? Oh, the first question, how big is the leadership slash shareholder team and how big is the company?
Okay, so 14 and 90 at this point
Mhm.
with the 7
You answered
offices. Yeah, and Carrie, I'd like you to talk a little bit about that next mentoring piece.
The balance, yes. It's
Mhm.
funny. I wish that we had some really good way of giving you a formula for it. We've had this conversation a lot, and there's no magic bullet for this. I know that sometimes you can find some statistics out there. It really is a matter of people that are moving into a shareholder position for the most part have to be frankly bringing in work and running the business, and so it depends on your growth, it depends on your revenues, so it's really it depends on what you can sustain in order to hit your goals, whatever your annual margins are. And so I will say you can't be totally top heavy. There is a point at which you can only have a certain number of people in those ownership roles. And then you do have to have a certain amount of staff in order to balance that. So I don't think that there's a magic number to that. It really depends. So one of the loose ways that we look at it is an average revenue generation from an associate principal, a principal, and a senior principal. And, no one's like held to that and, they're going to be chastised for not reaching those, but there's an incentive associated with it. So by hitting those goals, both from a sales and revenue standpoint, so it's not just sales, but it's revenue management and it's successful, fiscally responsible revenue management. So by looking at it on those levels, then you can see how big you can expand. Growth is a really great vehicle for ownership transition.
Mm.
So that's one of the good reasons to do ownership or to do growth and to focus on growth is because it gives future owners not only opportunities, but it gives them the ability to actually pay for your shares. So you kind of need to think about the long-term plan. I'm not kidding, Barbara, our plan right now is 40 years long or something. I think it's 43 years long. So
Yeah.
we have a super long plan ahead of us, and it's very interesting because some of the factors with it are just blacked out. We don't know who the people are. They're just unknowns at this moment.
Right. But we understand that's the need. I also want to share that some of our ownership is not just designers or design principals. It's people now in tech, marketing, our finance. So we're really looking beyond just the sort of typical, I would say, designer recognition, because all of those other members of our team are equally bringing in benefits to the company in terms of performance. So it's kind of a new mindset over the last 5 years, I guess, that we've been really looking at that next, not just the next generation of designers, but how do we round out the team to have all of those basic needs in our leadership group.
Yeah, expanding on that, the attitude is that if you can build in and sustain those people that are critical to your business, they can really focus on running the aspects of the business to free you up to do the sales, do the client care work, the mentoring of staff, all those things that you need to get to. And so you have to have a certain amount of bandwidth and financial overage in order to be able to cover those people. So you can't have all administrative people, obviously, but yeah, there's a bit of that factored into the formula as well.
Great, thank you. Next question is for Trish and Barbara. We'll start with Trish and then you can pass it off to Barbara. Any advice to let an owner know that you are interested in buying in, especially ones that are not open to discussing the future?
Oh, that's good. I actually can think of a reverse on that because, and I'll say the reverse first. An owner has to think, oh, I have this great key person. I'm going to, they're going to be thrilled. I'm going to approach them and say, hey, I really want you to be an owner. And they say, I have no interest in that. And sometimes that can create some tension. The owner's like, oh, they're ungrateful, or maybe what I thought of this person wasn't what they were. So now the reverse, how do you approach? I think it's almost, I won't say it's easier, but I think it shows I mean, it really shows that you're, a business person and you're invested and you want to, grow the company, I would say, not just take it over. I mean, you don't want to just step in and be rewarded, but I think it's definitely worth a conversation. But Barbara may know more on that.
Well, yeah, I would say communication's key, and that's on an ongoing process. And, as an owner, you should always be looking at who you think those next generation candidates might be and make sure that you're giving them the message and also communicating. From the employees, I'm going to only go back 40 years and tell you about me as an employee wanting to be an owner, literally coming to Stephen and Jules and saying, okay, I'd like to be an owner in the firm, and not having a vaguest idea of what that meant because nobody trained me, right? And the answer was break the door down, like show me what you got. What are you going to bring to the table? And I remembered, at first thinking, wow, how do I do that? And then putting, an action plan together for myself, bringing in clients, bringing in different expertise, bringing in a management consultant. Those are things that were raising the bar and bringing the current owners an awareness of, what I can bring to the table. So I would say break the door down.
Yeah, and maybe, say, I just listened to this great webinar, and I don't know, what do you think?
Yeah, I think the hard part, though, I mean, you have to communicate and ask. The reality is not everybody is going to want to sell their firm in an internal transition. You have to also face that reality and not stick around too long and miss an opportunity with the next chapter of your life. So I think it's better to have those conversations earlier than later.
That
Good
actually
question.
it kind of feeds into the next question, and this one's for you, Carrie. Any advice on asking for mentorship?
Yeah. I think show interest in wanting to grow and wanting to grow in ways other than just design. I think that it's important because honestly, someone's not going to see you in that role unless you show a desire and unless you are kind of like out of that box of just being a designer. So I personally think we see people rising up in our firm in future generations that we notice something about them. And so be noticeable, express yourself and ask for the mentoring and say, I'd really, I don't think there's any harm. I would never be upset if someone said to me, I don't feel really comfortable giving design presentations. I really like to work on presentation techniques. Can you help me internally, or could I take a workshop outside? I think that's, it's going to depend on the reaction of the person at the, who's leading your firm, but we would be delighted to get someone some skills development, whether we do it internally or externally. If somebody can help identify what they feel are their personal growth areas and then are looking for that, I think that shows the sign of a future leader, of somebody who takes this seriously and could potentially lead the firm.
I would also say do things on your own. If you feel one of your weak areas is business, take a Goldman Sachs class, take something online that, just gets you with the right vocabulary to talk to an owner about finances and things like that. It's not just being a designer. You need to have all the different components that we were just talking about. And again, bring that special value to the table that maybe you see a gap in the company. That gets people's attention.
Great, thank you for that. Trish, is there a threshold size that needs to be in place for an external sale? Given the cost of sale, et cetera, presumably it's not financially viable below a certain size.
No, there's no threshold. And there are many different buyers. You could have a two-person shop, in a certain city, and a buyer, it's hard to hire people. It's hard to find talent. So the buyer says, you know what, I'm going to buy that office, those two people, because that gets me there, versus trying to find someone to hire there, open a lease, get a lease, or transferring someone. So there's really no size, I have to say.
Great. I'm going to leave this last slide up while I ask this last question. So let me go ahead and share my screen again. Okay, this is the continuing education information on how to collect those credits on there. So submit your request to Teresa Nissen at teresa@iald.org with your name and AIA number within 5 days of the live webinar. The AIA LU is not available for watching the recording. So for anyone that's watching this on the recording, you are not available for that credit. CLD continuing learning unit must relate to one of the 7 domains of practice. CLUs are self-reported. LC, lighting education unit. LEUs are self-evaluated and self-reported. I'll leave that up while I ask the last question. This is for everybody. Let's start with Carrie, then Trish, then Barbara. What was one unexpected thing that you learned about maybe yourself or your company during this process?
I think I was not expecting there to be such vulnerable moments at times for everybody involved. So I don't know why I didn't expect that, but I didn't. But I was coming in as a buyer. It was interesting to me how much emotional management there was, and we get there, but it's a complex experience. And so I think you become closer through the experience of discussing it and planning it and negotiating it and sorting it all out. And I don't think I was expecting any of that. It was, I think that the deeper I got into it, the more complex it got. You would think that after the first buy, it was easier. I almost feel like I was naive the first time. I only knew so much at that time. And then as it got deeper and deeper into it, I became more aware, and I started shifting onto the other side of it and helping mentor and manage other people buying in. So for me, I was not expecting that to be such a journey of learning and development personally, or for the people that I was buying the shares from.
Okay, for me, I would say the biggest learning was you have to give to get, I think, bottom line. So sometimes that meant giving a little bit more of my time. Sometimes it meant maybe reducing a cost of share to somebody that I really thought was important to the team. And, so I think just give to get was bottom line for me. For the company, I think what was really exciting and probably not, well, planned, but, not realizing it as it was happening was how quickly the company was growing. Certainly in the last 15 years, we saw huge expansion geographically, different principals coming on board, some internal and some external. So I think the sort of what I think now in retrospect was such rapid growth, even though I know it was over 25 years, that was unexpected, and came with a lot of learning and management and communication that was sometimes more work than design work, because that was something I had to learn or think about or reflect on. A lot of communication, again, back to not just shareholders, but also, team members as well.
Yeah, I'm not sure that question applies to me in the firm, what
That's
we
But
run.
maybe you've had experiences though that,
What
with
you
some
had
of the
observed,
clients.
yeah.
Yeah.
What's surprising to people you've worked with?
Well, I just think that people need to be realistic. And I think the other key is to really start early and to, ask questions, whether they be of, these advisors, management consultants, or talk with your colleagues, and attend these kind of, webinars and things. The more you know or the more you understand, I think the process will be easier. You'll get.
Yeah, that's true. You get different perspectives and that helps you in your negotiation or setting your goals.
Right.
great. Thank you so much. And with that, we're going to end today's session. Thank you to our panelists, Carrie, Trish, and Barbara, for doing this for us, and to the attendees for taking the time out of your day to sit in on this. Have a great rest of the day and great rest of the week, everyone.
Thank you.
Thanks.
Thank
Bye-bye.
you.
Bye.